Breaking news from the Federal Reserve. Following its meeting on December 11th, the central bank has announced a major policy shift that has taken many market observers by surprise. We will now break down these actions and their potential implications.
The Federal Reserve has executed a significant policy reversal. After a period of quantitative tightening where liquidity was withdrawn from the system, the bank has now pivoted to a stance of monetary accommodation, which involves adding liquidity back into the market.
The first component of this shift is a cut to the benchmark interest rate. This key rate, which influences borrowing costs throughout the economy, has been lowered by 1/4 point of a percentage point. This reduction brings the new target for the federal funds rate to a range of 4.5 to 4.75%. Officials cite new economic data as the rationale for this move, suggesting a perceived need to support economic activity. In addition to the rate cut, the Federal Reserve announced a second, substantial action. Beginning December 12th, it will purchase $40 billion in Treasury securities each month, injecting that amount directly into the financial system. To fully understand these developments, it is crucial to examine the specific terminology the Federal Reserve is using, as the language of central banking is often as important as the actions themselves. Officials are carefully labeling this new asset purchase program as reserve management. The stated goal is to ensure the smooth functioning of the banking system rather than to provide broad economic stimulus. While the mechanics of creating money to purchase bonds are similar in both programs, the stated intentions differ. Reserve management is positioned as a technical measure for financial system liquidity. In contrast, quantitative easing, or QE, was explicitly designed to stimulate economic growth. Federal Reserve Chair Jerome Powell provided the official reasoning behind these decisions during his press conference. Let's examine the specifics of his explanation. When asked to justify the scale of the purchases, $40 billion per month, Chair Powell pointed to a recurring seasonal factor, the annual tax season. According to Powell, the large volume of financial transactions around the April 15th tax deadline constrain banking system reserves. He described the current purchases as a front-loading of liquidity to ensure stability during that period of high-volume fund flows. Accompanying this policy shift, the Fed also released its updated Summary of Economic Projections. This new forecast contains elements that appear, on the surface, to be contradictory. The updated projections show the Fed now expects stronger real GDP growth in 2026, revised up to 2.3%. Simultaneously, it forecasts that inflation will trend lower while the unemployment rate remains stable. This combination is unusual in standard economic models. This raises a critical question. An expansionary monetary policy designed to accelerate growth would typically be expected to put upward pressure on inflation. The Fed's forecast, however, projects the opposite, presenting an economic puzzle. The Federal Reserve's explanation for this outlook hinges on an expected surge in worker productivity. The theory is that technological advancements, potentially including artificial intelligence, will allow for higher economic output without generating inflationary pressures. The Fed's actions and rationale have led to two distinct interpretations among economists and market analysts, creating a clear division in how this policy shift is being viewed. The first perspective accepts the Fed's official explanation. Proponents of this view see the moves as a necessary technical operation to ensure the financial system functions smoothly, particularly in anticipation of seasonal liquidity strains. They do not see it as a broader stimulus effort. The second perspective is more skeptical. Critics argue that expanding the balance sheet and cutting interest rates is inherently inflationary, regardless of the official terminology used. They contend these actions contradict the Fed's stated goal of controlling inflation and amount to de facto money printing. With two competing narratives, we now turn to the potential impact of this policy shift on the economy and the key uncertainties that lie ahead. The immediate effects will vary across different groups. Investors may benefit, as lower rates and increased liquidity tend to support asset prices. Savers, however, are likely to face lower returns on their holdings. For borrowers, the cost of new loans could decrease marginally. Adding to the uncertainty is a looming leadership transition. Federal Reserve Chair Jerome Powell's term is scheduled to end in May of 2026. A new chair could bring a different policy philosophy, potentially altering the central bank's course. This leaves a final, crucial question. Is the Federal Reserve conducting a limited technical operation, or has it embarked on a new, more expansionary path that risks reigniting inflation? The answer will have profound consequences for the U.S. economy in the years ahead.